Comcast has become so ridiculously cheap that it's just become impossible to ignore. How's it going, everyone? Welcome back to another dividend growth investing video. I am Nick, and this is the Dividend Growth Income channel, where we are all about long-term dividend investing and building passive income centered around high-quality companies that pay a growing, sustainable dividend. If that's your thing, or if it sounds like something you want to learn more about, click that subscribe button. Thank you so much. I'm going to take a look at Comcast Corporation. This is a dividend stock that, like many, is down in a huge way in the bear market of 2022. I'm going to show you why it's a stock I'm buying and what I believe to be a good buy price for Comcast. Please keep in mind that I'm not a financial advisor or guru, and this video is not financial advice. Investing in the stock market is risky, so always conduct proper due diligence. We've talked about Comcast before on this channel in a recent video on dividend stocks that are cheap for the month of October 2022. It's my belief that from just about every metric, this company is almost laughably undervalued. When you hear Comcast, you probably think about cable and cord cutting, but there's so much more going on. Comcast is a highly diversified telecommunications conglomerate. When you invest in Comcast, you're getting a piece of Xfinity, which provides broadband internet and cable television services. You get a piece of NBC Universal. This includes Universal Pictures, DreamWorks Animations, Sky Group, which is the largest media company in Europe, Fandango Media with Rotten Tomatoes, sports networks with joint ownership stakes in the NHL Network and MLB Network, CNBC, MSNBC News. They own 7 different Universal Studios parks and resorts with locations all over the globe. And get this, as a Comcast shareholder, you even own a piece of the NHL's Philadelphia Flyers, as well as the arena where they play. Folks, this is not just a boring cable company. This is an entertainment giant. A giant that brings in a lot of profits, and with those profits, they've been paying their shareholders a growing dividend for the last 13 years. Now, I want to briefly look at the good, the not so good, and then I'll show you my spreadsheet valuation tool on how Comcast stacks up against several different valuation models, and we'll use that to determine a buy price. At the end of the video, I'll share my plans for Comcast. So here's why I would invest in Comcast and why I am a shareholder of the company. The first reason is I'm a dividend growth investor first and foremost, and Comcast checks a lot of the boxes I'm looking for in a company to buy and hold for the long term, ideally for the rest of my life. You have consistent revenue growth. Comcast has made more revenue in the last 12 months than any 12 months in the last decade, yet is now trading below $30. It's not been this low since March of 2016. Granted, 2020 was a bad year for Comcast and rivals like Disney, who had to shut their parks down. And look at this earnings per share growth. EPS was 97 cents in 2012, and in 2022 it's nearly 4 times that, now at $3.68. On EPS, they almost always beat estimates. Shares outstanding have been on the decline for the last 10 years. This is the graph we want to see go down, or at least not go up. They buy back shares. Hopefully they're doing so now when it's at these low prices. They pay a dividend that looks safe. It takes up 29% of earnings and 32% of free cash flow. So there's lots of runway to increase the dividend. Simply Safe Dividends gives us a safety score of 89. And Comcast has quietly had one of the better dividend growth track records of the last 10 years. 13 years of consecutive dividend growth and a 5-year annual growth rate of 13%, with their latest increase at 8%. And we'll be due to see another increase in April of 2023. At the time of publishing, Comcast is paying $1.08 annually per share for their dividend, and it's made in quarterly payments in the months of January, April, October, and June. The dividend is 3.69%, and get this, the yield is 82% higher than its 5-year average. At no point in the last 10 years have you been able to get Comcast anywhere close to this yield. Its PE is also at a low we've not seen in 5 years. It's trading at 8 times earnings. Its 5-year average is 14.2. I'm puzzled as to why Comcast is down so much, because everything so far sounds great, right? I mean, this company is bringing in more sales than it ever has. It is more profitable than it has ever been. So I want to try to find the negatives, the things that are not so good here, why we may want to avoid a company like Comcast. Almost any company we invest in is going to have aspects of their business that could use improvement. Comcast, no exception. First reason I could find is they do have a lot of debt, and with rising interest rates, this could get ugly quick. This is a lot of debt, folks, $99 billion, and they have a $135 billion market cap with less than $7 billion cash on their balance sheet. Perhaps with the dividend yield now being as high as it is, Comcast could maybe take a few years to slow their dividend growth to tackle some of this debt to position themselves better for the future. Now, the second reason to avoid I could see is the falling knife. This video is being published at market lows of October 2022, and we don't really know what's going to happen, but over the last year, the S&P is down about 13%, and Comcast is down over 46%. Now, this is total return, which is the price return, and it includes dividends paid. So the 5-year return is also ugly, even with dividends. Comcast has a negative total return over the last 5 years. It is down 12.76%. So this has not been a good investment, despite what looks like a very solid company. Trying to time the bottom of the market is a fool's errand. Comcast could still continue to drop. It hasn't stopped dropping in the last year. The big question is Comcast at a deep discount, or is it a value trap? And hey, if you're only looking for the short term, then I would stay away from Comcast because anything can happen in the short term. But if you believe their debt situation is manageable long term and that Comcast can still grow its profits even with the inevitable subscriber loss they will have in their broadband business, then I think this is about as good of an opportunity that exists in the market right now from a value standpoint. So we've seen the pros and cons. Let's look at our valuation tool. If this is your first time seeing one of my valuation videos, what I do is I take the average of 6 different valuation models that gives me an estimated fair value. Then I apply a margin of safety to determine a buy price. These light blue fields are the data I input. This is still a work in progress. And we have the ticker CMCSA and the share price at $29.27. I still can't believe this is under $30. Now, the annual dividend at the time of publishing is $1.08, giving us a current yield of 3.7. Entered in is a forward PE of 8 and a forward earnings per share of $3.68. The first model I factor is Graham's revised valuation. The analysts at Yahoo Finance estimate a growth rate of almost 10% for the next 5 years. I'm choosing to be a little more conservative here and going with a 7% growth rate. And I've entered the current yield for the 20-year corporate AAA bond, which today is at 4.57%. This has come up dramatically over 2022. And this gives us a fair value of $49.60. Now, had I gone with Yahoo's higher growth estimate, that would give us a fair value of just over $60. But again, I prefer to be conservative in these estimates. The second model here I use is the dividend discount model, also called the Gordon growth model. What this does is assumes a constant dividend growth rate and then discounts the future dividends to the present value using a required rate of return. The 5-year dividend growth rate for Comcast is 13%, and their latest increase was at 5%. And with their debt being kind of high, I would like to assume going forward they're going to go into the mid to high single digits for growth. So I selected a growth rate of 6.5%. I couldn't really decide between 6 or 7, so I went to that halfway point. A discount rate of 9%. This gives us an estimated fair value of $46.01. The third model is the discounted cash flow valuation, which is similar to the dividend discount model, but values the company based on the present value of future cash flow. Here I'm assuming a free cash flow growth rate of 5%, which I think is reasonable. A perpetual growth rate of 2.5%. And this just means that after those 5 years, we're going to go forward with a slower rate of growth. Discount rate of 9%, and that's our required rate of return. The current free cash flow for Comcast is just under $15 billion, and I entered 4.58 billion for shares outstanding. And what happens here is we add up the value of the future cash flow, then discounts it to the present day value, and then we divide that cash by the shares outstanding. This gives us a fair value of $57.30, so it's very undervalued in terms of free cash flow. And I think this is the first time I've seen all 3 of these models come up this much over current value on each of these valuations. That's pretty unique to see. The next couple of valuation metrics are relative to itself, and these are also going to come in high. The first is the dividend yield theory valuation, and what this is we take the average 5-year yield and we calculate what would the price be if Comcast was yielding at that level today, because these things often revert to the mean. Now, by this metric, Comcast would be valued at $53.47, if it was to be yielding 2% with its current dividend of $1.08. The next relative valuation metric is the PE mean reversion valuation. And this calculates the stock price based on its historical 5-year PE, which I've entered as 14.2, and this gives us a fair value of 52.26. The final valuation metric I'll add here is simply, I take the average analyst price target, and I get this from Seeking Alpha. I think it's good to include this because sentiment matters, right? And the price target for Comcast is $46.71. Putting all that together, I have an estimated fair value for Comcast at $50.89. This represents almost 74% upside. Now, please don't just go out and buy Comcast based on this spreadsheet. I could be wrong somewhere, or off on one of my estimates, or the calculation could be wrong in the sheet somewhere. No, it's always nice to have a margin of safety if you're going to buy individual stocks. For a company like this, I'd go with a 20% margin of safety, and this gives me a buy price of $40.71. So to me, this looks like an excellent stock to dollar cost average into for the next stretch. As long as it's under $40, I think it's a buy. And that's just me though. In fact, I have been doing just that here in our public dividend growth income portfolio. And although it's just one of 20 stocks we're accumulating slowly, and I've started this portfolio as a way to slowly dollar cost average into new positions I had no exposure to. But with Comcast under 30, I am actually considering opening a position in one of my other accounts and buying up some shares and making this a bigger position for me. It's just gotten too cheap to ignore, and the risk-reward profile here works perfect for my goals. There's so much to like here, and that's what I'm doing. Guys, I hope you found this helpful. If you did, please smash that like button, and if you stuck with me this long, I really thank you so much. It means more than you could ever imagine. More to come, guys, including portfolio updates and more valuations of stock just like this, and I'll try to highlight some other interesting stocks, And if there's anything you would like to see, like a video review like we did here of another stock, just let me know in the comments, and I'll see when we can fit that in, okay? Also, just do check me out on Twitter, @DivGrowthIncome. I love connecting with like-minded investors. Thank you for watching, guys. Until next time, keep investing.